And for the first question, the offer that is there is a dinner for two at the Explorer restaurant in Kampala, Serena. For the second question, and this has to be someone who is a bit stressed, you get a spa treat at Active Body Therapy. So if you're feeling a bit stressed, this second question is good for you. Okay, do we have any question in the room to Gibran or to Chris? Okay, they're online, huh? Okay. To the first question in terms of the number of branches that Stanbic Bank Uganda has, and the second question in regards to who is the head of Stanbic Bank Global Markets Uganda. Also at this point in time, I'd like to take special mention of some special guests that we have with us today. I would like to recognize the presence of one of the directors of Stanbic Bank Holdings, Mona Mugume. You're most welcome. I would like to recognize the presence of the Stanbic Bank Management Exco. Most welcome. I also take recognition of different industry heads and sector players in the telecoms, manufacturing, trade, and construction industry. You're most welcome. I also note and recognize in a special way the presence of the Special Presidential Assistant for Economic Affairs. That is Dr. Christine Charity Mwebesa. You're most welcome to the forum. Okay, the questions for Gulam and Chris. Yes, there is a question at the second table.
Thank you so much, moderator. I'm Jane Narunga. I work for an organization called Siatini, and I appreciate the presentation from Gulam and Christopher. I have two questions. For Gulam, he talked about the global dynamics. He talked about the challenges of multilateralism, but I wanted him to bring it back home a little bit, to look at how those global dynamics are affecting our continental free trade area, because that's our baby, and that's the promise we have to be able to grow our economy, to grow our intra-Africa trade as Africa. So what are the impacts of those global dynamics on the continental free trade area? For Christopher, he talked about coffee and also the prospects of coffee. But what we know is that coffee, we are still exporting raw coffee, and I think we need to debate how we exit the commodity dependence, the export of raw materials. And I think that's the source of our ever-increasing trade deficit. But I wanted him to talk about the impact of the regulations coming out of the European Union, the unilateral measures, the deforestation regulations, and all those other measures coming out of the EU, and how they are going to affect our coffee. Just a little bit of that, so that we can get prepared. Thank you so much.
Thank you so much. We do much appreciate those questions. So the online questions are streaming through, and I'll just quickly run through them. In regards to monetary policy, what are some of the indicators the central bank is looking at to lower the benchmark rate currently at 9.5%. It seems the RIR has continued to be high, above 5%, even though inflation has been subdued to a very stable rate with minimal volatility. Isn't RIR acting as a brake to the economic growth? Secondly, what is your take on blockchain technology, AI technology, and quantum computing in relation to the financial industry? Thirdly, with the rapid growth of fintech, AI, and digital payments in Africa, how is Stanbic leveraging these technologies to stay competitive while enhancing financial inclusion? The next one is productivity measurement normalized for cost of capital, or is it purely a function of labor hours? In other words, if one American outputs 1,000 crates of soda per hour, while it takes 10 Ugandans to do that, if the total cost of labor in Uganda is lowered, does that make Uganda more productive? Very interesting question. I'm sure the manufacturers are clearly listening to this. And the last one is, I have a question for the panelists concerning the international financial system with respect to Africa and Uganda in particular. What is your take on African Development Bank's proposed new mechanism to hedge currency risk in development financing? In brackets, using an uncirculating currency backed by Africa's critical mineral resources. I would like to hear your perspective from Uganda's context, and that is it. So probably Chris and Gulam. If Gulam is still online. Gulam is off? Okay, so Gulam is off, so I think this question will be handled by, Chris, will you want to give some of it a go? Okay, thank you.
Thank you very much. With regards to, there was a question by the lady on EU regulation. I think it will be negative for the coffee sector, because I think what it portends is that fewer, or there'll be a reduction in exports to the EU with regards to our coffee. And I think that will then increase, possibly widen the current account deficit, put pressure on the currency. So I think it will be prudent for coffee exporters to find a way to comply. I think we all living today in a world where there's expectation that you need to be sensitive to environmental concerns, and as much as possible, if you could improve your processes to incorporate ESG, that will help over the medium to longer term. So it will be a shock, I believe, to the coffee sector. Hopefully, we will not see a decline this year, but I would be concerned about that. There were quite a number of other questions that were asked. I don't know, hopefully some of them will be addressed in the panel, particularly with for example, the question on the Bank of Uganda, what the metrics they use. My understanding from my previous experience as a central banker, the key measures were looking at the inflation and inflation outlooks, expectations. Are they well anchored? Are they not? What were for example, the policymakers seeing with regards to developments in balance of payments, developments in financial markets? I think those were some of just the broad, high-level measures that the central bank uses whenever they're considering changing their policy stance.
Thanks so much, Chris, for the responses. Much appreciated. We want to move on with the program in the interest of time. We're moving to the second session. But prior to that, we did indicate that our client voices are critical to us. And at this point, I would like to take us away back to the digital space. We'll have one more video of our client voice. Thank you.
In the realm of success, where dreams intertwine, our lives flourish, rich by design. From boardroom conquests where visions take flight to family laughter that dances in the light. It's the joy in each moment, the legacy we build, a promise fulfilled as our hearts are filled. With every investment, horizons expand. It's not just banking, it's a world at hand. For in lifestyle, in family, in growth we explore. Together we flourish, because with us, there's always more. So you see, it's not just banking, it's a world of more. Talk to us today, and let's introduce you to a world beyond banking.
There is no question to the fact that Uganda has a lot of potential that is just waiting to be unlocked.
In 1994, I started with an investment of $2 million. And my vision was to put up excellent quality product here. And really, that it was after 50 years that the vision came true.
We started with the production of tubes, wire products, galvanized wires, and obviously roofing sheets, right? Aim has been one, to provide a quality product in the market, which means it lasts very long.
Playing the role of lead bank for Roofings Group over the years and seeing the value that has been created over time, it's clear testament to the role that the bank has played in this growth journey. In particular, the advisory services or lead arranger role that we have held clearly demonstrates the value that they have brought to the East Africa region.
I always marvel at the scale and the impact that Roofings has had in this country. When you think about their core product, steel, what is steel not involved in? It's involved in construction, both for infrastructure and homes. It's involved in manufacturing.
The products are made here by Ugandans, for Uganda. We are building our economy together. And the range of products that we produce is not only appreciated locally, but also export.
As we went ahead, we felt a need of going into backward integration. That means having a cold rolling mill complex.
We started building the cold rolling mill complex in 2010. And Stanbic Bank was the lead bank of the consortium of the bankers.
See, Roofings has been an excellent success story in East Africa, because what we have got in East Africa is the technology, the quality, and more important, the upliftment of the people by way of providing good quality products.
Now, these are just some of the ways that we at Stanbic Bank are enabling and impacting by providing transactional services that will continue to stimulate the growth of the economy.
We are always playing catch up with Roofings, because Roofings has plans, it has very bold vision, but we are committed. We're committed to being an effective partner in enabling their ambitions, both backward and forward integration, expansion to ensure that they're delivering for the country and they're meeting the country expectations, and making Uganda an export powerhouse.
When we listen to the founders and what they want to accomplish in East Africa and the potential investment that's still to materialize, we are excited what the future holds for this group.
Our journey has been very long, very fruitful, and here we are.
We continuously invest in our ability to lead and foster thought leadership across many of these changes. And the reason for that is that we would like to be at the forefront with our customers in trying to peer into the future and help them prepare for it. That's what we believe in. We believe in it.
Thank you very much, and we hope that you're receiving insights from this symposium. We are then going to move to the second part of our session, which is a panel discussion. But before we do, we'd like to take a special recognition to for our board chair. He's joining us online. You're very welcome, Mr. Damoni. We're happy to have you here. We are now going to get into our panel discussion, and it will be just a nice flow from Gulam's presentation into East Africa, what Chris did share, and we're going to have 3 panelists, and I'm going to just request that we please turn our eyes to the screen as we welcome our panelists.
Bethuel Karanja. Bethuel is a high-impact global markets leader with 20-plus years of experience driving business growth in Kenya and East Africa. An expert in financial and capital markets covering FX, interest rates, derivatives, and equities. He excels in strategic planning, risk management, and digital innovation. Ladies and gentlemen, welcome our moderator, Bethuel Karanja. Dr. Adam Mugume, a leading expert in monetary policy and economic forecasting. Dr. Adam Mugume oversees research at Bank of Uganda with over 25 years of experience and an Oxford University background. His work directly impacts Uganda's financial stability. Ladies and gentlemen, welcome our panelist, Dr. Adam Mugume. The 2025 Stanbic Global Insights Symposium. Dr. Fred Muhumuza, a leading voice in policy research and economic development. Dr. Fred Muhumuza has spent over 20 years advising governments, private sector players, and international organizations. His expertise in political economy analysis and regulatory impact assessments makes him Ladies and gentlemen, welcome our panelist, Dr. Fred Muhumuza. Walker. As IMF's resident representative for Uganda, Sebastian Walker brings deep expertise in fiscal policy, international finance, and economic development. With a PhD from Oxford and a career spanning multiple global economies, his insights shape economic policies across Africa. Ladies and gentlemen, welcome our panelist, Sebastian Walker.
Thank you very much. What's important, we did mention earlier that you have a QR code as a panelist are sharing. Please do ask questions, but also share expectations. We've mentioned earlier that feedback remains key for us, and so we'd like you to use this opportunity to give us a feedback. I'll just pass this on to Bethuel. Over to you.
Thank you very much, and good morning, everybody. Great to have each and every one of you here, and welcome to this panel discussion at the 2025 Stanbic Economic Symposium. We are here to explore economic trends, policies, and the future of the global and local economics. We've heard from Gulam, our group economist. He spoke broadly about the uncertainties in the global front and where we find ourselves today. We also heard from Christopher, our regional economist. He brought it home. He spoke about local macros. He spoke about the key sectors of oil and gas, agriculture. He also gave us an economist view of the monetary policy, interest rates, and the currency. There were some highlights from the comments from those economists. Gulam spoke about confrontational era that we find ourselves in. And he told us that we cannot ignore the US. Chris spoke about the IMF and the fast oil. He also spoke about Uganda. He said Uganda is growing faster than its peers, which is quite a big positive. He spoke categorically about the coffee prices and the need for us to watch out on those. But right now, we are privileged to have in front of us a panel of distinguished experts who will bring diverse insights and perspectives and valuable experience into our conversations. Our panel today has been introduced. From the far left, we've got Mr. Sebastian Walker, who is our IMF representative for the country. We've got Dr. Fred, who is a policy researcher and development analyst. And we've got Dr. Adam Mugume, who is the Executive Director of Research at the Bank of Uganda. As we navigate this era of rapid and predictable changes, marked by global uncertainties and shifting economic paradigms, our discussion will shed light mostly on the opportunities that lie ahead for us as a country. Our panel will continue to share their expert opinion on key topics, including tariffs, trade, aid, debt, tax, and credit growth. I will encourage all of you to participate, including those online, and reflect on the insights that we received today and pose thoughtful questions along the way. With those few remarks, I'd like to dive into this discussion, and I will start with you, Dr. Fred. We will dwell on tariffs. That has been a big topic of the day and has been a big topic since Trump came into power. The US will not be the last country to impose tariffs. And it actually looks like this is a new global trade order. I have a two-fronted question to you. What opportunities do global tariffs war present for emerging markets like Uganda? And how do local businesses position themselves to thrive in this transition from the era of globalization to protectionism or confrontation, as Gulam called it earlier? Over to you, Dr. Fred.
Thank you. Good morning, everybody. My current constituency is where Mumba has shifted to a new constituency. I also, about 3 years ago, shifted into the Makere University Business School. Reason was really to blend economics into business. And tariff language is economics, but the tariffs apply on businesses. And that space has been very, very complex. I was really delving into the theme here, where we are saying globalization reshaped. I'm like, hey, reshaped is past tense, but we're actually in an active space. But then there was that other tagline of riding the waves, surfing economic shifts, which brings it back into a very turbulent space. This is not the first time we hear of tariffs, but Trump says this is a good word, and indeed they have been there for some years. But you don't want to use them to disrupt the systems. You want to use them strategically. And what's our strategy? And I'll be speaking to, sometimes we have a lot of optimism that does not speak to strategic intentions. And we've seen this really Trump realizing every morning. He imposes tariffs on Canada and Mexico, and then realizes he's trying to protect Americans. But an American vehicle is across those 3 countries. It's not made in America. The processes begin in Mexico, sometimes in America. A vehicle bounces in Mexico into Canada. By the time the vehicle is done, it has crisscrossed those borders several times. So the evidence coming through is a vehicle is going to become $3,000 more expensive in the US with these tariffs that Trump thinks is protecting his own citizens. So you want to have those strategic level issues as you impose your tariffs. They should be informed by the economics, they should be informed by the political ambition and interests, so that you don't end up hurting yourself. So while he announces them, he says, okay, tariffs on auto vehicles suspended. But you have already brought a disruption. Nobody is going to trust you going forward. People will still be thinking of what else do I do. Then you impose tariffs on China, and then you realize you buy so much soybean. Of all things, soybean from the US that China imports. And now the Chinese don't eat soybean as such, but the Chinese eat a lot of animals. We are all in Lent, and especially the other Lent, I won't mention the names, but you understand. So they use the soybean to feed those animals because they must have them in every village. And so you want to understand those dynamics, but I'm like, now where is Uganda in all this? We can grow soybean and replace, even if it is just 0.5% of what China was buying from the Americans. So we can benefit from these tariffs, but we need to be very, very deliberate. And I think in Uganda we have a lot of optimism anchored on nature. We talk about climate, you talk about the environment, the people are here, the rains are all over, the soils are fertile. You have no idea how much food we are importing from Tanzania with all those things. So if we're not deliberate to look into these tariff waves, we need to become surfers. Those guys ride the waves, so they are happy to see the waves. But if you are a poor swimmer like me, that is if I'm at all a swimmer, the waves will sweep you away. So we need to be looking at these tariffs to say, where is our advantage? They can be bad, but you can also pick some good things out of them if you are very strategic to know what you want to do with those specifics. I'll just for now end with a good story. I picked good and bad as well. A manufacturer in Uganda who is in the agro value chain has been importing maize, of all things maize, from Zambia. So his complaint was Zambia has imposed a ban on the export of maize. I'm like, yeah, that's a problem. Tariffs, right? But this time it's a ban. But what in the first place was the Ugandan agro processor doing in Zambia looking for maize? That for me was the real center of focus. So there are quite a number of things that optimism is good, but really unless we get down to specifics, we are not going to be on the good side of these tariffs that we are seeing. And we need to take advantage of them. They have a lot of negative implications on us. They will also have a lot of positive implications. But we need to sort out that so that we can see where exactly do we position ourselves, more so as we want to grow our economy going forward. Thank you.
Thank you so much. I think two words that I picked there, deliberate, and we need to be surfers. And sticking on tariffs and what impact it's likely to have on local economy, I'll move on to Dr. Mugume. The tariff war is dominating global headlines. Could you help us unpack this and what it means for the dollar globally? What is the central bank's outlook on the dollar globally? We saw the outlook from our economists. It would be good to hear what the central bank outlook also is. And what does that mean to the currency, to the local currency, Uganda shilling, going forward?
Good morning, everybody. I think that is a question that sinks deep into the banking sector on where is the dollar likely to go with these global developments, including tariffs. Now, because it is not one way. America imposes tariffs, China revenges, Canada revenges, Mexico revenges. Then the question is, where is the dollar likely to go? The dollar is likely to go where the global economy goes. If the global economy goes into a nosedive, for example, some people have been saying, we could see another round of recession. I think it's still far-fetched, but the slow growth in the economy probably could also cause a volatility into the exchange rate market. It is still early to say whether the dollar is strengthening, because last week, for example, we saw the euro gaining heavily against the dollar. And then, so globally, the dollar was also weakening. So is the trend likely to continue? It is still early to say. But overall, what the whole tariff thing introduces into the global economy is the volatility. And I think we had a good, I think it was the manufacturers who said what they require is stability. So once you have an exchange rate that is unstable globally, it automatically feeds into both the domestic economy and also where what the central bank really does. I think related to that was also a question. When you are setting the policy rate, behind the scene, we also look at the dollar. Where is the dollar likely to go? If the dollar is volatile, you also don't want to fuel that volatility with the monetary policy easing, even when you know that monetary policy easing is required. But when the outlook is gloomy, when the exchange rate is likely to be volatile, you tend to shy away and say, you know what, rather maintain tight stance and see where the dollar, how the exchange rate market is likely to evolve before I take a policy action. So for now, to cut the whole story short, it is still early to say where the dollar is likely to go and how it is going to impact us in terms of the exchange rate. But overall, I think we should remain cautious in terms of the monetary policy to see really that we can maintain stability amidst all those challenges. Thank you.
Thank you so much, Dr. Mugume. And cautious is the word, and it's still early days. I think one of the points that a regional economist raised was on the fast growth that we see in Uganda relative to other East African economies. However, there's still a question on rapid growth of exports. And with the rapid growth of exports, we see that as a key to closing the trade deficit, especially now that the external debt burden that was displayed to us is increasing in size. Outside of oil, what are the key exports that provide a significant upside opportunity for narrowing the deficit? And how can both private sector and government work together to unlock these opportunities? That question is for you, Sebastian, and I can repeat it.
It was on. Thank you. No need to repeat it. Good morning, everyone. So I'm going to start by just challenging the question for a second on at least two levels. One is you say that exports are key, and that might be true, but to stick with that analogy, there might be more than one lock on the door. And then also, as policymakers, we don't tend to focus on specific sectors, but rather on creating the general conditions for businesses to thrive. And I'll start by elaborating on that. Helping businesses to thrive in general will be helpful for the economy, and it will be helpful to exporters, amongst others. And so what do you do to help businesses to thrive? Well, one aspect is going to be improving governance in the country. Others might include improving the infrastructure and the human capital through better education in the country. So we want to create the conditions for businesses in general to thrive, and exporters in particular will benefit from that. But one thing that has been hindering the competitiveness of exporters has been, in the IMF's assessment, a moderate overvaluation of the exchange rate. Now, that is something that, of course, makes exports more expensive to the rest of the world, and therefore it can penalize exporters to some degree. But let me turn to the other key to open the lock in the door, which is imports. Narrowing the trade deficit will also benefit from a reduction in imports. And here the government has a role to play through fiscal consolidation, both through a containment of other current expenditure and through better domestic revenue mobilization, and notably through an expansion of the tax base, which remains too narrow to this day. Thank you.
Thank you so much. Now we'll shift gears a bit And the next question will go to both Dr. Fred and Dr. Mugume. It's a topic that is going around. The economist spoke about it. And this topic is about the dependency on foreign aid for African countries. We saw the map on how dependent some of the African countries are, especially from the US aid that we know now has been paused. Africa and Uganda, for that matter, have historically had a reliance on aid to fund some of the critical social relevant sectors, such as health and education. In light of the recent policy shift in the Western world, with the donor funding and aid, what structural reforms need to be adopted by African countries to ensure sustainability going forward? We can start with you, Dr. Fred, and then finish with Dr. Mugume.
Thank you. How did we get here? People are asking, how do we get out of here? I think it's quite tricky. It's true, and we've been emphasizing these exposures, and we're here talking about the exchange rate, but how have we been stabilizing the exchange rate? America still remains the biggest pusher of dollars into this economy if you talk about bilateral relations, and this has been with us. So we kept that as if it was a given, and it helped us quite in a number of ways. The support in the health sector, the support in education, but also the support in governance, that a lot of NGOs that have been benefiting from the US support, and previously we had DGF. And thank you, the presenters, for bringing the issue of institutions and governance. These things do matter, and you saw the correlation there is very strong. If you want to grow, your governance, your institutions are key. And so speaking on what does this mean, there are a lot of implications we have already seen in the quick high-frequency data indicators. If you check with Revenue Authority and look at pay as you earn, there are already disruptions there of people whose jobs were cut instantly, so they are not paying any more taxes. So even as we focus on domestic resource mobilization, you want to understand the base that you are taxing so that you can design the right policies, one, to first solidify and strengthen that base before you get into how do I tax it. It looks like Uganda, we are more into how do I get the money out than how do I put it in there. That's a quick indicator we have seen. But I think it has also rippled out in the banking sector. Some of these individuals had taken on salary loans. The insurance companies that had covered that are already feeling it. Some of them are already shifting from houses where they were, the rent. So landlords are asking questions. My best paying client is leaving without even a 3-month notice, because they too are not given any 3 months notice. So there are serious implications that you don't want to just discuss lightly to say this has gone and this is coming through. Thank God the USAID PEPFAR is still bringing in the ARVs. For information, Uganda has about 1.4 million people who have to get their ARVs every day, courtesy largely of PEPFAR, which is the American Presidential Emergency Fund on HIV/AIDS. But it's not just about the drugs, because that was immediately restored. It's about how do you get this drug to that 3-month-old baby and their mother to prevent the transmission, because there are quite a lot of science in there that I don't want to get into. But the network of the human resource that makes sure these drugs are available to the people is not yet restored and addressed. And we can't easily just integrate it into the mainstream of the health system. So there are physical implications besides the financial implications out there that we need to be watching so strongly and so seriously. I had a privilege, my friends in Ireland took me to Ireland last November to go and engage in what they call economics, thanks to the ambassador and the team out there. But when I was there, I was enjoying the economics and the business. Remember, Ireland was part of the pigs when the global economic crisis hit. The economy was literally shattered. 15 years down the road, they have rebuilt it and they have a budget surplus. But they were very deliberate. One of the areas where they were very deliberate is really in the pharmaceutical world. And this is why you come back to say America has been giving us the drugs. Were we and have we been deliberate to develop certain sectors to give us resilience and limit our exposure? Especially after COVID, we are all celebrating, we are out of COVID, we are back to the pre-COVID. I mean, the pre-COVID was already too low. 6% growth for an economy with almost 3% population growth rate, adding over 1 million people per year, half of whom of the population in Uganda is below the age of 17 years. That economy needs to be growing double digit. So we cannot celebrate anything less than double digit. Being deliberate on these issues is what has exposed us to surviving on handouts and aid. And that's what I'm saying, until we address those fundamentals, we can't easily just talk and say the Americans are gone, we will replace them. No, you need to be very deliberate in what you do. So the Irish, first of all, had a very good road, and they said, how did you finance this road? This is the European Union. So European Union is part of their story. Can Uganda say East African community is part of my story, Africa, free continental area, in terms of building infrastructure? I don't see that. So the dynamics of global comparisons come in to say, where are we vulnerable and how do we get out of this? If you want to Google, you'll find out how did the Irish manage to build the pharmaceutical industry. One, they are English speakers. We also speak English here, so have we taken advantage of that? And I've been telling my friends in the educational sector, we need to begin teaching Arabic. Arabic is not Islam, it's a language. And as long as we have these 1.4 trillion generators of foreign exchange, who can easily replace the Americans going to the Middle East, teach them Arabic? It's a language. It will help them to blend into that world. That world is going to continue sucking in people who can help us to generate the alternative dollars. And these are quick ones. You don't need a standard gauge radio to get these dollars. You don't even need, transmission lines. No, the planes are already there to take them. And the demand is out there. A few things that we can do, and we've been doing that. The other thing, the Irish were they designed their tax policy to attract investors. And we know their taxes, they didn't pick from a certain IT company. And the European Union is saying, please pick those 14 billion. Because you should. But that's how they attracted the investors. So how is our tax policy designed to attract FDI? There are even people here who hate FDI by its terminology. They also had a well-educated workforce. I'm going back to say the Americans have been here investing in education, but how deliberate have we been to make sure education actually helps us to build resilience, to build exports, to substitute imports? We seem to be operating in a laissez-faire economy that you can just fly out there without any deliberate preciseness. So for me, it's getting back to those details, that whether the Americans come back and they're not coming back, already we are being told 80% of USAID is cut, so the 20% will have to share it with the rest of the world. But how do we survive? How do we secure that foreign exchange? Both now and going into the future. So we've got to be very deliberate. These should be lessons for us to become very, very strategic, very specific. The World Bank Economic Update, thank you World Bank, sometimes you're not just a bank for money, but a bank of knowledge, and I lean more on that side. And thank you Stanbic, this is not about lending, this is about knowledge. And for me, it's the knowledge space that the banks bring on the table that is critical, that we are creating jobs, but total factor productivity in Uganda has been on the decline for 2 decades. And labor productivity in services, in industry, in agriculture has been on the decline as well. So it's not just about jobs and skilling for jobs. Where is the total factor productivity? So that the people you are employing can deploy their brains and work. These questions are very, very fundamental because they will help my friend Adam Mugume to manage what is there. If the dollars are not there, what is he going to do? He doesn't mint them. He doesn't really, what does he do? So his space is sitting out there that monetary policy will be exposed to these uncertainties. And as I've said, like surfers, the wave is here with us. How do we make sure we ride the wave, even if the world is not yet reshaped? Thank you.
Thank you so much.
I tend to concur with what Dr. Fred has said, that we need to go back to the drawing board in a planning perspective, and probably the forthcoming national plan will reflect on some of those. However, I also want to be a bit more positive. Remember in 1990s, foreign aid was contributing around 60% of the Ugandan budget. So basically, only 40% were, at one time I think had even gone to 70%. So we have seen a gradual reduction in budget support from aid over the years. What we see in the numbers now, we are talking NGOs alone bring in around $560 million per year. Bulk of that is obviously related to US. We have also seen that USAID alone brings in to the tune of about 700 million or so in various sectors. So, but that, if you talk about USAID of 70 and NGOs of around 500, that is around 1 point something billion. Uganda's GDP now, this fiscal year, is around $59 billion. So overall, in terms of GDP percentage, aid is a small component compared to where we were in 1990. So we should also, on that side, we should say, yeah, Uganda government has done a good service to rely less on aid and look into more of domestic resources. However, the challenges remain. In a short time, this is a shock. All of a sudden, you have been depending, as Dr. Muhammad has said, you have been depending on these flows. You are exposed in the financial sector. You're exposed in terms of taxes. How do you recover from that shock? Now, I mean, that is a big question. To the extent that we have to rely, the risk management, whether it is the banking sector, automatically the risk parameters kick in. How do you limit your exposure to some of these frauds that are linked to aid? So in that case, you can also have non-performing loans spiking. But not really substantial, because again, as I said, because this is a small component of GDP, probably I think this will die out. The question is, how do we move forward? How do we start replacing this dependency on aid going forward? I mean, you cannot rely on your neighbor to give you food for ages. At one time, you have to stand up as a man and say, you know what, I have to feed my home. And I think that's really what Dr. Mumz is saying. I mean, you can't be saying that Uganda with $59 billion GDP, you're talking about $60 billion next year, you are unable to cater for the drugs that go into for treating HIV. I think really that's where now it comes to the bottom line. How do you plan to make sure that you provide for these services with aid, without aid? Relying on your neighbor to provide for you everything is out of the question. The question is, how do you make sure that now you plan? It is not that Uganda doesn't have money. Uganda will have money. It is a question of how do you allocate it proportionately to ensure that you are shielded from some of these shocks. And in some cases, when everything is going well, we tend to consume everything we earn. There is no saving. Whatever comes in the tax coffer, you have already spent it even before it started coming in. So the question is, how do you go back and say, you know what, because of these shocks that are prevailing, how do I build my buffers as a government, as a household, as a financial system, so that in the event that you have a shock, you are really protected? I think really that's what we should be talking about in the years that are ahead. Thank you.
Thank you so much, Dr. Mugume. And indeed, the percentage of aid to GDP is a small number. You're talking $60 billion versus about $600 million. and you've spoken about the need to allocate resources properly in the right places. Dr. Fred earlier spoke about the need to attract investors and the need to look at the productivity of labor. I'll shift to you back to you, Sebastian, and we'll stick to economic growth, specifically oil and gas, and looking ahead post oil and gas. So the development of oil and gas are clearly touted as big prospect for growth in the medium term for Uganda. What key interventions should the Ugandan authority be looking to implement to sustain high growth rates post oil and gas development phase?
So it's important to emphasize from the beginning that the development of oil and gas is not going to be a magic bullet for the Ugandan economy. It will lead to a boost in growth as you go from nothing in the oil sector to something. But it will be important to support the economy more generally until oil comes, while oil comes, and after oil is gone, because it won't be produced here forever. And here again I go back to what I was saying about strengthening the general environment for businesses to thrive. This goes through some of the key interventions we've identified: strengthening governance and fighting corruption, which I note that His Excellency the President has made one of his priorities; strengthening infrastructure, notably the availability of electricity and roads and other forms of transportation; and strengthening human capital, notably through education, but also through health. These are all essential things to create the conditions for businesses to thrive. And I want to say again, as policy advisors, we cannot advise to support specific industries. We want to create the conditions for all businesses to thrive so that the best will come out on top. Thank you.
Thank you so much for that clear and precise answer, Sebastian. And you've spoken about good governance. You've spoken about the ability to make sure that we diversify our economy away from oil. Now I'll come to you, Dr. Mugume. 2025 is a pre-election year. And historically, African economies suffer from rising inflation in the periods during and shortly after elections, usually on the back of this electioneering period. How do we reconcile the potential physical pressures that may arise out of the forthcoming general election and the central bank's mandate to ensure macroeconomic stability? Further, what is central bank outlook of the economy over the next 12 months? Quite a broad question.
Okay, thank you. Let me start with this small analogy. Monetary policy in the central bank, the way we see it, or the way it is conducted, is like driving a small car on Kampala roads. A small car is the economy, because the Ugandan economy by default is small. When you are driving, there is a pothole, there is a border on the way, you have to navigate through all those jargons. So that's basically how to manage the economy. You are driving a Vitz car, all of a sudden there is a pothole that will swallow the Vitz car. You can't overspeed. You have to go speed limit either 5 kilometers per hour, or even if you know that you can go speedily up to 80 kilometers per hour in terms of generating growth. So some of these roadblocks, potholes, borders, are the things that we meet as we conduct monetary policy. So one of them, therefore, is in electioneering. So electioneering is like any pothole when you are driving a car. It comes, you have to navigate. How to navigate it is that make sure that you don't overspeed during that time, because you know your car is Vitz, it will be swallowed by the pothole in the road. So basically, that's how we navigate with the monetary policy. That's how we manage the economy in terms of in all those jargons. So elections, the only year I think we are caught off guard was 2011, 2012. And I think that one I agree, the central bank, I was in the central bank, we messed up a bit. Lucky enough, there was no Ugandan to dismiss us by that time. Social media, I think, was not as volatile as it is now. Otherwise, we have lost jobs. We allowed the economy to overheat, overspeed in the potholes, and in the process, we had the inflation. But since then, we learned our game also. We learned that during that time, you have to see how do you navigate this without being swallowed by a pothole in the road. And we saw that in 2015-16, we went through, we had exchange rate that depreciated, etc., but real inflation remained muted. 2021, election came with COVID, with lockdown, we navigated through quite well. Well, so we have really mastered the game of trying to anticipate where we are likely to see all those challenges, roadblocks, where we see, for example, normally the election comes with another combined effect. Normally elections come with low agricultural production, with exchange rate that is volatile. So that combination is really what complicates the whole scenario. It is not necessarily about government expenditure. It is about people are not in the gardens digging because they are getting free money from elections. And then exchange rate is depreciating because FDI is sitting on the fence. And then you have the question mark about the policy stance that is likely to come. So all that combination is really what complicates the story. As I said, it is a combination of potholes and border riders and indisciplined drivers. All that combined is what the central bank tries to navigate through. And we believe that this time around, where we are now in 2025, we see we have managed to, I think you saw the chart of money supply. We have constrained the liquidity to the extent that, including Stanbic, now looks at the central bank as a central bank. Before, even the banks were saying, central bank, you have nothing to do because we have our money. But now, liquidity is with the central bank. We have constrained the liquidity to the extent that now all the banks look at what the central bank is doing in terms of the supplying liquidity. And that one has helped, on one hand, on the also exchange rate stability. So we know where the liquidity is. We know that the government is also not likely to, is constrained by expenditure on the expenditure side. So we are coming from a background before elections that is more stable, and we don't believe that these shocks that are coming through electioneering, coming all weather-related, the global developments, etc., will really, constrain the economy or cause inflation to necessarily rise beyond what we are anticipating of around inflation remaining around 5%. So overall, I think unless something extraordinary happens, like for example, if the wars within the region escalate and the global dynamics become worse than what we are seeing, we believe that come the next elections will sail through with really no distortion. I hope I have answered your question.
Absolutely. And I've had a couple of things. I've heard about potholes and the fact that central bank is indeed on top of this and is in full control. We heard from our economists that the Central Bank of the Bank of Uganda is one of the most proactive institutions in the region. And thanks to that, of course, having learned from the mistakes of the past, as you mentioned, the 2011, 2012 mistakes, we are not likely to see those mistakes in the future. We are now going to shift gears and talk about debt, tax, and credit growth, which are pertinent topics to all of us. And on that, my first question will be to Dr. Fred Muhumza, Uganda debt to GDP ratio is forecast to remain near 50% for the next couple of years, and that is considered sustainable by most economists. On the other hand, our tax to GDP ratio is approximately 13.8% and has a lot of room to grow. What, in your view, needs to be done to broaden the tax base sustainably, and what, in your professional opinion, needs to be done to cure Uganda's hitherto perennial fiscal deficit strategically and conclusively?
Thank you. Quite an interesting question that really builds on what Dr. Mugume has mentioned. Economics is really about how do you ride the storms. It's neither here nor there, but you still must remain in that storm and manage. And there are lots of contradictions that we always deal with. An economist can't make a ruling like a Supreme Court and say this is it. Even when we do, we keep looking over our back. Because everything you do, damn if you do, damn if you don't. So you want to get back and say, building real on the conversation, aid might be 1 billion out of the 60 billion. But where was that aid going? The brain is not a big part of our body, but every doctor will tell you it must have the blood it needs for the rest of the body to function. So you cannot simply balance out blood equally and say the legs must have this much. The brain must first get its share. If it doesn't have it, you're going to faint. And that's a good way to preserve you. So sometimes some good shocks are good. Because if you continue and the brain doesn't have enough, you might die. So the current monetary policy is really working against tax mobilization and growth. And it's a debate by economists out there. At what point should I stabilize the economy and then allow it also to grow? If the potholes are too many on the road, you possibly need to change the car. Not these small ones. Get a big one, even if it means hiring or renting it. Because the small one won't take you there. So how do we balance fiscal and monetary policy? Every time you curtail money supply, your brain is not going to function as it should because it doesn't have sufficient blood. So there is very little aggregate demand in this economy because we want to solve the inflation issue. But we cannot let inflation come back because we are pursuing demand. How do you balance out that journey? It's not just a central bank issue, but also the fiscal side. So I want to get back into the economy and say, where is the money? Is it all sitting with the central bank? Possibly not. You have shown us there how much money is locked up, and I say locked up because I don't know what it is doing in terms of return to investment and growth in the economy. The treasury bills and fiscal bonds. The bills, I can understand you're trying to manipulate and manage money supply. But these bonds, maybe we also need to get there, and if it's a government, stop issuing that big stock of need for money, scale down your appetite. Can we scale down the fiscal deficit? Can we scale down government spending so that we don't have 25 to possibly even 35 trillion shillings locked up in government bonds, which are not coming back into the system because we simply refinance? But on top of that, we are paying about 10 trillion of interest payment going to that in the coming years of interest, which money government would have used to do other things that grow the economy. But remember, that takes first priority on the budget. So how are we going to grow the economy so that we can also grow the taxpayers? Because the taxpayers are sitting in that economy that we are not allowing to grow. So you cannot raise your tax to GDP ratio. You cannot, no matter how well you do your domestic resource mobilization, if the pond is dry, there's no fish in there. Can we first get the fish in the pond? That for me is the bigger question that we need to sit down and address. Looking through the numbers, you bankers, you know about 9 trillion of your money is locked up in courts. This is money you are paying interest on. It's neither here nor there. I don't know where it is, but at least it's locked up in those processes. 13.7 trillion by the Auditor General's report is in government areas. So really this body is anemic. And as I always say, even if you are a blood donor and you come to donate blood and you are anemic, those fellows will tell you, thank you very much for the gesture, but please go and eat first. They will even give you some tablets. And that takes me back to Ireland. They are taxpayers you reach and you really sympathize if you're a tax collector. So why don't we first give this guy some 3 years of tax holiday to recover, and then he can pay his taxes. So we have this very tricky situation, but which is all coming from the macro, fiscal, and monetary policy trends we have taken. Their consequences are clear on the economy. I've read Bank of Uganda surveys. There are people banks are hesitant to lend because they are closely associated with Mr. Government. With it 13.7 arrears, you are very sure you are creating a non-performing asset by lending to that individual. So how do we sort out those blockages, those potholes he has mentioned, so that all sorts of cars can move smoothly on these roads? That's a nightmare that we cannot begin to debate an outcome of a tax to GDP ratio that is below without resolving how did we get here and how do we get out of here. And I hate debt to GDP ratio. It is just an irrelevant indicator. When it was created, we were talking about debt by the multilaterals. This was debt World Bank lending to us 0.5% for 40 years. Now we have debt of 17% for 5 years, 2 years, 3 years, 4 years. So your debt to stock is no longer the issue, but literally the liquidity associated with that debt is what we should be talking about. And when you get to those liquidity indicators, the story changes. You begin to see the gravity of the threats. That even as you're trying to go through your budget of 66 trillion, close to 50% of that is going into debt management. So it's literally not available for you to service your debt. Talking again about that, the budget we are in, you look at budget support, literally donors giving us money to say, budget support, you go and do what you have to sort of. The budget call circular, the current one we are using, which was issued mid last month, talks of budget support of about 1.4 trillion last year. 1,393.7 billion. That has collapsed to 26 billion as we speak. Of course, there may be some commitments before we finalize the budget. But that's a big dent. You can't continue business as usual. You can't switch that money from anywhere else because it is locked up. 9 trillion is already locked up, human capital development, underfunded. 10 trillion is locked up in security. And this region is insecure. We are like America. Don't talk about Ukraine and Russia. We still have in our neighborhood, Sudan is not peaceful. South Sudan has issues. DRC, we have Operation Soldier in there. Somalia, we are still engaged. Ethiopia, you're watching all these spaces. So I cannot even say, Mr. Security, can you reduce on your 10 trillion? You'll never know what will hit you. So in such a tight fiscal space, you won't be very keen to say, I need the taxes, but I don't need to kill the taxpayer. So how do you again get back into the razor edge problem to balance the need for more taxes and the need to secure the taxpayers? The biggest bully in the room, and thank you, Adam, for raising the days of structural adjustment in 1990, it was about cutting government spending. Until we talk seriously on cutting government expenditure, our deep-seated problems are going to remain. And you can have a few proposals. The government fleet, I wish I could sign an executive order. For 3 months, park all the cars. Let only this category, ministers, PSCs, we removed the directors, the commissioners are too many. So you just get into those fellows, park them, let's review. And we have ability to review. You can save $1 trillion already from that alone. But these guys will still come and work. I don't think Momba here is going to preside over a fleet that brings his employees to work. Cut, put it on their salaries, they will be more frugal with their money. Some will ride border, some will shift to nearer houses. I know government officials who sleep 40 kilometers away because the fuel is free, the car is free. Why should you sleep in Entebbe, Mukono, Jinja, and you work in Kampala? That irrationality can only come because of an irrational government behavior. And we need to get there first. Cut these things, executive orders, then we go to court. By the time we are done with court, you will have settled yourself out, and then it will be time to settle it out of court. I'm looking for those serious, draconian decisions. Thank you. And thank you for clapping, please. Thank you.
Thank you so much. Indeed, that was a powerful submission. You said we need to grow the economy, to grow the taxpayers. And you spoke about arrears, you spoke about non-performing loans, and you said we need to lock the potholes and make the road smooth. Now I'll move back to Dr. Mugume. Further to your earlier submissions, this Uganda economy is projected to grow between 6 and 7.5% over the next 2 to 3 years. This growth is expected to be driven by investment in infrastructure and extractives, including oil and gas. The private sector is key to driving this expected growth. Two fundamental issues, however, hamstring this capacity. One, domestic arrears, and two, cost of credit. How is the government, and to some extent, big extent, the central bank, looking to address these two pertinent concerns?
Very crucial argument there about private sector credit growing in the range of, by December it was, on an annual basis it was around 6.4%. We saw in January numbers it had picked up to around 7.7% growth rate. And then the interest rate, however, interest rates actually came down. In the 3 months to January, we are talking about a weighted average of around 17.4%. In the 3 months, I think to November, it was around 18 point something percent. So overall, the weighted average running interest rates have slightly edged down, but also private sector credit growth has also slowed down fundamentally. The one, and then you also have talking about the arrears. However, the non-performing loans, the ratio of loans in December declined to around, I think, around 3.8 or 9%. So the biggest giant in the room is the return on government securities. We saw, for example, if I buy a treasury bill for 1 year, I will get a return of around 15%. If I buy a bond for 2 years, I will get something in the range of 15.5 or 16. So if I can put my money in a government bond, although now people have started saying, hold on, are they likely to government default on the bonds? But for now, because the central bank stands ready, so long as it's a government bond in Uganda shillings, the central bank will always pay irrespective of whether government has money or not. So we took that undertaking on behalf of the government, that whatever bond matures, the central bank pays, and then the central bank claims from the government. That's where we saw in last year, we had accumulated around, the government had accumulated around 9 trillion in terms of borrowing from Bank of Uganda through that arrangement. So there is no argument that the government is going to default on bonds, and because the central bank is paying. So the whole thing therefore comes, if really I can, as a saver, I can put my money into bonds and I get 15, 16 or 17, for the 20 years is now around 18. Why should then, even if it is a bank, why should the bank also now give a loan to a person at below 18% or 15%? It is actually, I mean, for the lender will sit back and say, okay, my risk-free return, which is a government bond, is 15% or 16% on a net basis after taxes. So why should I give somebody who is likely to default, at less than 15? It has to be higher, and that is why I'm talking about 18, 19% lending interest rate. So the biggest driver, therefore, of lending interest rate is the behavior of the government borrowing in domestic market. Now, however, there is hope in the horizon. We see that in the years, thank God for the oil revenue that will start flowing, at least we see that from the macro framework, we see that the demand for domestic borrowing will start declining. So that's the only way that now banks will start looking at the liquidity they have in terms of the deposits they have mobilized and say, okay, we have now to locate it into the borrowers. But for now, the government as a borrower is paying a better return than a private person, so the banks therefore also have to look at that return. I think really that's even if actually you have to reduce the money, policy rate, still the heavy borrowing by the government would still be a driver that contributing to the lending interest rate. And then you have also we see that